Welcome back to the Investing Iguana, where we break down the latest financial news and what it means for you in Singapore. Today, we're diving into a hot topic, the sharp drop in Singapore's one-year Treasury bill, or T-bill, yield. The latest auction saw the cutoff yield fall to just 2.29%, down from 2.95% in January. That's a pretty steep drop in just 3 months. But what's really going on here? And how does it affect your savings, CPF, and investment choices? Let's unpack it. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, retirement planning, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I've produced over 800 videos with more than 350,000 watch hours as of December 2024. I also focus on regional and global economic trends. First, let's get the facts straight. The Monetary Authority of Singapore just wrapped up its latest one-year T-bill auction. Investors piled in with a whopping $11.2 billion worth of applications, even though only $5.3 billion was on offer. That's a bid-to-cover ratio of 2.11, showing demand is strong, maybe even stronger than before. Yet despite all this interest, the yield you can lock in for 1 year has fallen by 0.66 percentage points since January. So why are yields dropping even as demand stays high? The answer lies in a mix of global and local factors. Globally, the U.S. Federal Reserve has started cutting rates after years of hikes. Singapore's interest rates tend to follow the U.S., and we're now entering a lower rate environment. Locally, Singapore is awash with liquidity. There's a lot of cash sloshing around, partly from investors seeking safe havens and also from regional inflows. When there's more money chasing safe assets like T-bills, yields go down. In other words, the government doesn't have to offer as high a return to attract buyers. Let's put this in context for Singaporeans. For a long time, T-bills were seen as a safe, relatively attractive place to park your cash, especially when yields were above 3%. Many people even used their CPF Ordinary Account, OA money, to buy T-bills, hoping to earn more than the OA's 2.5% interest. But with the latest one-year T-bill yield at 2.29%, that math no longer works out. After accounting for the loss of CPF interest while your money is locked up, you'd actually be worse off using your CPF OA for T-bills at these yields. It's not just CPF savers feeling the pinch. The best one-year fixed deposit rates in Singapore are now around 2.45%, higher than the latest T-bill yield. That's a reversal from last year when T-bills easily beat fixed deposits. So, if you're looking for a place to park your spare cash, fixed deposits might now offer better returns, especially with the added flexibility. But why is demand for T-bills still so strong? Part of it is safety. With the global markets volatile and economic growth slowing, many investors are willing to accept lower returns in exchange for the certainty of a government-backed instrument. There's also the risk that rates could fall even further in the coming months, especially if the U.S. Federal Reserve cuts rates more aggressively. Locking in a one-year T-bill now, even at 2.29%, might look attractive if rates drop below 2% later this year. Let's talk about the broader impact. Lower T-bill yields signal that Singapore's interest rates are likely to stay low for a while. That's good news if you're a borrower. Mortgage rates and business loan rates could come down, easing the pressure on homeowners and SMEs. For HDB flat owners with floating rate loans, monthly payments might get a bit lighter. On the flip side, savers and retirees who rely on interest income will find it harder to get decent returns without taking on more risk. For investors, this is a wake-up call. Relying on T-bills or fixed deposits for meaningful returns will get tougher if rates keep sliding. You might need to look at a more balanced portfolio, mixing in some equities or higher-yielding bonds to achieve your long-term goals. Of course, that means accepting more volatility. So it's important to know your risk tolerance and investment horizon. Here's the key takeaway. The sharp drop in Singapore's one-year T-bill yield is a clear sign that the era of easy, risk-free returns is fading. If you're using CPF OA, the numbers no longer add up for T-bills at these yields. Fixed deposits may offer a better deal for now, but even those rates are likely to fall if the global rate-cutting trend continues. For those with mortgages or business loans, Watch for lower rates ahead, but don't expect them to fall overnight. So what should you do? Review your savings and investment strategy. If you're sitting on cash, compare T-bills, fixed deposits, and other options. If you're investing for the long term, consider diversifying beyond just fixed income. And if you're using CPF, make sure you're not sacrificing guaranteed interest for lower returns. That's all for today's analysis. If you found this breakdown useful, hit subscribe and let us know what you think about the falling T-bill yields. Are you still buying, or are you looking elsewhere for returns? Share your thoughts in the comments below, and stay tuned for more insights from the Investing Iguana.